Ladies and gentlemen, please welcome on stage your moderator and distinguished panelists.
Hello, I'm Karen Cho, anchor for Squawk Box Europe on CNBC. It is such a pleasure to moderate this panel. I feel like I've been on the front row of some of the large capital flows that we're going to be talking about here, covering the global financial crisis, of course, the Eurozone banking issues, COVID, and some of the big changes that lie ahead. We're already talking about that when it comes to monetary policy divergence and the new risks around geopolitics. So thank you very much for having me here today. And I'm going to introduce you now to our panel. Joining us, of course, is Geeta Gopinath, who is the first Deputy Managing Director of the IMF. Sebnem Ozkan, who is the Professor, University of Maryland. Professor. Lesetja Haneho, who is the Central Bank Governor of South Africa. Roberto Campos Neto, Central Bank Governor of Brazil. And Catherine Mann, Professor of the Practice of Brandeis University. Now, we have about an hour for this panel discussion. First up, we're going to talk about the state of play, where we stand today, lessons from the past that may be relevant for the future, and then we're going to turn to some of the key challenges ahead. Well, first up, First Managing Director, let me turn to you. First Deputy Managing Director, the resilience is a word that we're hearing a lot about. Despite the aggressive rate hike cycle, it's been unusual. We haven't seen large craters, large fund flows at this point, even though there's sticky inflation around heightened geopolitics and also stunted growth out of major economy China. Just talk to us about what we're witnessing now, what's been notable for you, and where we stand today.
Thank you, Karen. And I'm very glad we're having this very important conversation. So firstly, in terms of the big question of where is the money going, if you look at the period post-pandemic, one of the most popular destinations for the money is the US. So a third of global flows are going to the US. And if you compare that to what it was pre-pandemic, that number was 18%. If you look at emerging markets as a whole, I'm taking the whole group, there is heterogeneity, but if you take the emerging market group as a whole, we've seen what I would describe as weak net flows into the emerging market group as a whole. If you look at their share of global flows that they are receiving, pre-pandemic, that share was 25%, now it's 20%. Within that box, one of the countries, of course, where flows have reversed quite a bit is China, but it's not a China-only story. And somewhat more worryingly, if you look at foreign direct investment, which is so critical for growth in emerging and developing countries, that has been the weakest it's been in the last 20 years to this region. Now, why is this? It reflects many factors, including very strong growth prospects in the US, weakening growth trends in some of the major emerging market economies, and of course the big interest rate differential that we're seeing between the advanced economies and emerging markets. Now that said, the good news is of resilience, and the resilience is reflected in the fact that there hasn't been a big major crisis in emerging markets, despite these weaker flows. And we haven't seen it, what typically happens in form of a sudden stop in flows either. And why is that? And that's because emerging and developing countries develop much stronger macro policy frameworks to be able to deal with shocks of this kind. So we've seen very valuable resilience.
Thank you very much for that. Professor, let me turn to you, because as we talk about resilience, you've spent many years, this is your life's work, talking about capital flows. First up, I want to talk about some of the drivers, because we've seen already a lot of FX moves that could have implications. We're seeing still fiscal deficits remain, and we're talking about more challenges on the monetary policy front. So what are the drivers as you look at the world today?
So this is actually a point that goes exactly what Ms. Gopinath is talking about as the difference between emerging market as a group and heterogeneity. I think the drivers of capital flows in terms of the global factors or the push factors have not changed that much. So I also expect a lot of flows coming into US moving forward, given that US interest rates are going to be higher for longer. Not just portfolio, but also FDI flows, given the industrial policies that incentivize those type of flows. But I think what has changed for emerging markets, a heterogeneous way, not true for every emerging market, but for the ones that change and help them in terms of resilience, is this monetary policy credibility. Monetary policy credibility, strong macro policy frameworks in general, but especially monetary policy credibility, I think helped emerging markets weather this time around Fed hikes that came after the pandemic shock. And when we say monetary policy credibility, we have to think about, of course, other domestic vulnerabilities that emerging markets, again, not all of them, but some of them that address, which would be the debts in foreign currencies. So when you have lower debt in foreign currencies and when your monetary policy really deals with your domestic issues, you have a lot of credibility, and that really helps you a lot. Let me give you an example, the sudden stop, right? So even though this time around we didn't see very serious sudden stops, there was a short-lived one in, if you remember, March, April, May 2020. And that time around, actually, we looked at this in our research and we realized something very interesting. Generally, during these type of events, you know, money gets out, comes back to US, and this really affects emerging markets in terms of, you know, lower investment, lower output. This time around, actually, it didn't happen. And it also didn't happen when Fed started raising the interest rates in 2022. Again, yes, they did lose the capital flows, but then, you know, it really didn't affect in terms of a contractionary outcome the emerging markets that really lowered their dollar debts and improved their monetary policy credibility, which means monetary policy really dealt with the domestic issues, domestic inflation, output stabilization, and not exchange rate related and capital flows related issues.
Thank you very much for that. Governor, let me turn to you, because I mentioned the COVID shock when I opened the conversation. We did see this as a sudden break on many emerging and frontier economies. The oil crisis then got in the mix too for a lot of these economies. Outflows soared. Conditions have eased in recent times. As you consider the landscape, is the worst now over for EM countries like yours when it comes to that liquidity squeeze and the impact on capital flows?
Which governor? Oh, you just said governor.
That governor. Look here, I think that just we'll have to take that from resilience. And the point of departure for resilience is that resilience starts with good policy frameworks. And good policy frameworks have got to be thought about first about whether they can be implemented. And that sort of like frames it. And in a way almost determines where the flows actually go. So I'll give you the case of South Africa, that in the period between 2003 and 2008, we had fairly decent growth, of course, fueled by commodity cycle and so forth. And the flows were non-debt creating. They were going into the equity market, getting into those companies that are invested in the commodities market, and that is where the money was going through. The period after 2009, the policy setting changed. The response to the crisis was to provide fiscal stimulus. And so when you provide fiscal stimulus, there is a lot of debt being issued, and we had a decent credit rating at the time. So the composition of the flows switched to debt instruments. And what that actually did was to create a perverse incentive in the minds of the policymakers, because then what you then had was that they thought the stimulus was permanent instead of being a response to the crisis. So getting the flows and having the flows being resilient in the sense that they are coming in is one thing. where the flows actually go almost determine how you are going to have to deal with the outflow down the line. So this week I spent a lot of time talking to investors. And of course, what do? I convince them that they must buy South African instruments, okay? And only to be in a panel like this to be warned about the dangers of capital flows. And then so I end up with a split personality. I would like to have these flows, but at the same time, they are dangerous. But bottom line is that what determines the resilience of the flow is the policy framework which will end up channeling the allocation of those flows and thus tell us whether the flows are debt generating or non-debt generating. And in most instances, the non-generating flows had also proved to be very positive for growth, because if they were going into the equity market, they are going into the private sector, into private investment, and it had tended to be more efficient than public sector investment, at least in the South African space.
Terrific points after all the yield chasing we've seen in recent times as well. Governor, now let me turn to you, and I have a different question for you.
Okay.
When I started out in Europe, we were talking about Brazil being a hotel for hedge funds. And I'm sure you remember that phase, all the hot money that flooded into your country. Then, of course, politics got in the way and it went in the opposite direction. Now, Brazil has had a favourable 2023. Your stock market's been had its best year since 2019 last year. A lot of EM funds are now overweight Brazil. China Plus One is working for you. But what vulnerabilities do you still see ahead?
I think the vulnerability comes a lot from the global, and it's difficult to elaborate a point without actually picking up on what Lisette just said. If you do a basic exercise, you look at where the sovereign debt is today, and just add three parts. You add U.S., Europe, and Japan, and you look at what the debt was before the pandemic crisis and what it is now, and you find that there was an increase of around 24% of GDP. But then when you look at the cost of servicing the debt, that more than doubled, almost tripled. So the question is, where is the money going to go? Well, it's probably going to go to pay a lot of debt, and the problem is, we have been in this movement for a long time now that the government, is the solution for most of the problems, and most of the solution has been through that. Whereas we had phases before in which we increased the debt, but then we were able to rapidly decrease. That has not been the case right now. So when you turn into Brazil, Brazil has done a good homework during the crisis, because it's one of the few countries that actually has done a lot of reforms. I remember going to some meetings and telling people in the mid of the pandemic that we were doing a social security reform, and then we did a lot of other reforms, and last year we presented a reform. This year we presented last year, but still this year we presented a reform, a tax reform. We did a fiscal framework. Obviously, people always questioning to what extent you were able to follow the framework, but we did the framework. And so I think Brazil has done a lot of the reforms. I think the key challenge is, again, going back to what Lisette said, is what is the role of the private sector in that? I think the governments are highly indebted. And the problem is you create this circle, these vicious circles in which you have higher debt, and then the fiscal becomes questionable. But then because of that, expected inflation starts going higher, and then you have higher inflation, and then higher inflation creates inequality, and to fix inequality you need more social programs, which create more debt. So I think that's the vicious cycle that we don't want to get into that right now. And I think the key challenge, going back to the main question, is to be able to reinvent ourselves from here on with more private enterprise, private capacity, and more policies for growth, understanding that eventually you need to promote growth, but with less government, with less debt.
Just quickly, do you still think there is a risk today of investors checking in and checking out as quickly in Brazil as they have in the past? Is the money any stickier these days?
I think if you look at you have to segment. So if you look at the portfolio flow, you have the equity, and we have had some outflow in equity lately. And then when you look at that, there is a lot of inflow. The debt market in Brazil has become very a national market. So if you look at the percentage of foreign investors owning the long end of Brazil has diminished a lot as opposed to some other countries. So it has become much more of a local market, and it's working well. The capital markets in Brazil have increased a lot. During the pandemic, we had a point in which we had some moments of stress, but it was very limited compared to some other markets. We are already reaching record high in terms of emission issues of fixed income. So I think the market in Brazil is very strong. The financial deepening that we were able to promote in the last 5 years is amazing, and that actually created a better allocation of resources. We just need to make sure that we keep with the reforms, because this is a market that for you to keep growing, you need to keep with the reform, with the reform agenda.
Governor, thank you. Professor, a lot of us have spent all week talking about policy divergence and its implications. You're also an external member of the Monetary Policy Committee for the Bank of England. So I want to bring up the stubbornness we're seeing in inflation, what that means for central bank policy, because I think we're all on the edge of our seat being data dependent and what the impact could be. Now, policy has been quite similar to date. There is now the potential for this tipping point. So what would policy divergence mean for capital flows?
So thanks very much. I'm going to pivot a little bit from the discussion of capital flows to the drivers of capital flows, which is interest rate differentials. And one of the things that I think we have to recognize is that collectively across advanced economy central banks, not all of them, but some of the major ones, they all almost at the same time decided to pursue a strategy of hold. Although each one of them might have decided that that was the appropriate policy action at the time, what has led to, of course, is volatility moving from the policy rate end of the curve into the rest of the curve. And over the course of 6 to 8 months, you end up with 100, 150, 200 basis point moves in the curve. And those movements in the curve are associated with a reassessment by financial markets as well as by policymakers of economic activity and inflation, prospects for those, and the nature of the central bank reaction function. I think it's important to ask the question of whether or not a more activist policy, the one that I was pursuing in the course of my votes, which are all transparent so that you can find out how I voted, that rather than all of the volatility being in the middle part of the curve, which then translates into volatility in capital flows across markets at the medium-term end, whether or not that outcome is more or less beneficial for growth than something that had volatility more spread over the entire curve, including at the policy rate end. The research on business investment, productive finance, as mentioned already in terms of actually going into markets, into productive activities as opposed to trading activities, the uncertainty about the middle part of the curve is more deleterious to that type of investment than if there had been more, as I say, volatility over the entire curve as opposed to just the medium-term end. The second issue associated with this position now is of the hold is exactly the policy divergence as central banks start to evaluate the appropriateness of both the timing and the pace of moving off what has become known as Table Mountain, based on my colleague at the Reserve Bank in South Africa. So again, what this does is concentrates, in contrast to being on Table Mountain, putting all the volatility in the middle part of the curve and at the end, now looking for the timing and the pace of moving off of Table Mountain, it moves the volatility all into the interest parity condition at the short end of the curve, which then, of course, is going to be reflected, and we already observed in exchange rates. So I think that we, as collectively evaluating our policy stance, have a number of different concerns that these policy choices have contributed to volatility in capital flows that has been observed in other markets.
Professor, thank you. Let me come back to you, First Deputy Managing Director, because there was a well-used phrase by many of us, the canary in the coal mine moth, that's signalling for what's coming for a lot of emerging markets. You've had many of these over the years, whether it was around the Asian financial crisis and various different events. As we talk about resilience, how do we preserve resilience in future thanks to some of the lessons of the past?
Yeah. So I would just reiterate several points that were made by Roberto Liseccia and Shebnem. Firstly, good macro policy frameworks plus whatever you can do to raise growth, because that has been the weakness in growth is an important factor. On the macro policy front, I think right now what is important is for governments to recognize that they are sitting on very high levels of debt. And therefore, this is a good time to rebuild fiscal buffers, do it credibly, gradually. You don't want to break the economy, but it is important to move in that direction. And what we saw over the last 4 years, that if you have good frameworks, you can actually then use the credibility you have built up to do a few unconventional things. And for example, we had, a third of emerging market economies that did quantitative easing for the first time during the last 4 years, right? They did asset purchases. That hadn't been done before. But the reason they could do that without having to see much turbulence and reaction to it is because of the credibility that they built up. So I think that's the first lesson, is that you need to use these moments to build up credibility, which you might then have to use a little bit in the future. The second, of course, challenge, which we are all talking about resilience, but the show isn't over yet. We have, there is still countries that need to bring inflation back down to target, and we are seeing more bigger interest rate differentials that are driving currency movements. And therefore, this is an important time for central banks to look at, at the data and see how are they going to react. An important part of what we're seeing in terms of currency movements is coming from what we call just fundamentals, which is the fact that interest rates are likely to be higher for longer in the US relative to other countries, and therefore that's going to drive currency volatility. But there are moments when you can get market overreactions, you can get financial stability risks. And again, in those moments, FX intervention can play a role if it's done in a temporary manner and for financial stability reasons. So that's the other thing, is for authorities to basically realize that the different instruments that they have and how to use that optimally to manage these complex times.
I want to talk more about those instruments and tools with you, Professor, because shock absorbers play a key role here, but even the Japanese are very cautious about intervening in markets. We've seen that despite, a 34-year low in yen versus the dollar. I spoke to the South Koreans this week. They are looking at certain interventions. The Indonesians have gone for it. They're using intervention currently. Do these types of tools work in 2024?
This is to me, right? All right, okay, but let me first take the chance to connect what just Gita said and Dr. Mann said. This volatility in the short end of the curve that works through the parity condition, that actually what life was for emerging markets, always. Okay, so the fact that now the countries like United Kingdom, Canada seeing this, they are small open economies, and countries like Brazil and South Africa always experience this, emerging markets, because emerging markets borrow short term. And that's exactly why it's so important to separate, the fundamental drivers that is driving that versus the part that feeds into that short end through the policy, non-credibility, mistakes, and all those things that financial markets price into the short end of the curve. I think that's super important. And we have seen that through this crisis, and actually that's exactly what the funds integrated policy framework try to do, right? This is how we come to FX intervention. The funds integrated policy framework is exactly about that. Let's not create, unnecessary financial stability related policy risk that will feed into that parity condition, into the short end of the curve, which is really how the interest rate differential and capital flows move from the US to the emerging markets. So how do you do that? As we know from the integrated policy framework, you don't use monetary policy to, control the exchange rate volatility, to try to bring back the capital flows, right? You use these other policies. What are these other policies? FX intervention, of course, when you use exactly for these reasons, macroprudential policies, preemptive capital flow management policies. But I think the nice thing that, in terms of the lessons learned through the crisis, and as spelled out clearly, Fund's Integrated Policy Framework, is these policies are not like a, cookie cutter for every single country, right? They are going to be right for certain countries and not right for the others. And that's going to go back to your domestic conditions, go back to your dollar debt, go back to your monetary policy credibility. So in that sense, I think, we really have a framework to know how to do this. We lived it through these crises, and it is the time now to capitalize on this. Let me give you one example, Chile. Chile is a country that doesn't use capital flow management policies, rarely use FX interventions. In fact, they use FX interventions exactly as Ms. Copinath mentioned. During this crisis, Chile did face a sudden stop. They did see the capital flows going out. And the work that I have been doing with both the fund colleagues and the colleagues at Central Bank of Chile, we showed that actually the really interesting new policies they came up with during the crisis, such as central bank credit lines, sovereign guarantees, those really help to switch the domestic firms and households funding, not just from foreign lenders to domestic lenders, but from dollar to peso, which is a very, very interesting phenomenon. Because generally during these events, what we know is it is going to be very difficult to borrow in your local currency because there's going to be a premium. Why? It is short term, and the lenders are not going to lend you in your local currency because there is depreciation risk. So in that sense, these policies Chile central bank and government put through really neutralize that lack of foreign funding, both in terms of lenders and also in terms of dollars. And I think this is exactly what we are learning from this crisis. We have a framework here at the fund to study these more, and this is one of the good things that is coming out of this experience.
To your point that not everybody's using FX intervention, I mean half the Governing Council over the ECB this week telling me that they don't target FX, just a reminder. But I want to talk about what tools central banks should use with you, Professor Mann, because independence is still quite key. We've seen when that's gone badly wrong, and I'll cite an example in Turkey when the independence is questioned. We are in an election cycle this year for a lot of economies. How careful do central banks need to be about the timing of using their toolkit and the types of tools they use at this point to preserve independence?
So I think we go back to the research that the IMF has done on the role of central bank independence and inflation targeting as critical ingredients to supporting an environment of less volatile growth and less volatile inflation, so-called great moderation. And a lot has been ascribed to the roles of central bank independence and in inflation targeting. However, in that research, we also have to remember that during that time period where we were in a less volatile environment, that global engagement, global integration was also a very important ingredient in achieving the objectives of a more stable economic environment, both for economic activity and inflation. So a real concern is in the nature of moving forward with global fragmentation, both on the trade and on the financial side. We have to recognize that the complementarity of global integration for the great moderation. What that means going forward, I think, is that central banks are going to have to use their autonomy and their role very effectively going forward. We are moving into an environment of more shocks. We've already observed them, and the notion that they're going to go away and that we will return to the great moderation is probably a mistake. And therefore, in an environment of greater inflation volatility, central banks, the premium on central bank independence, on autonomy and inflation targeting increases. Why is that? Well, even if you have volatility in inflation of equal size, positive shocks and negative shocks, even in that environment, we know that both prices and wages are downward rigid. So even if you have the same size shocks, there's an upward bias to inflation. And so central banks have to always be on the alert, so to speak, for this upward bias to both inflation, to both prices and wages that creates an inflation premium that could show up in R-star in the long run.
Governor Neto, let me come back to you. We were talking before about the change in maturity debt profile and how that can help. Now, we know that some EM countries have found a way to dial down the heat that they're facing, moving away from short-term liability dollarization to longer-term maturity in terms of debt. I mean, an Argentina 100-year bond jumps out to me. Mm-hmm. Is this useful as a tool, or does it just kick the can down the road, to use a European phrase?
No, that's a very good question. But before that, I have to say that it's amazing how this intervention issue comes up, because we were in a press conference yesterday, and I had only two questions about intervention effects, and the two questions were from Japanese reporters, which was very surprised. So you can tell that that is a big issue in Asia. And I'd like to get to that point before I answer your question, because this is very important. I think one of the lessons is that what has worked well for emerging market countries is the principle of separation. And every time we break away from that, I think there is a dent in credibility. And the principle of separation clearly says that you use interest rates for monetary policy, you use macroprudential measures for financial stability, and the FX is floating. And then the question comes, but what about interventions? So Brazil was 1 year without any intervention effects, and actually that made the news because it was a long time that we didn't do that. And I always ask myself, what is the optimal intervention? And here it's very important to understand the markets are very linked, and that's coming from someone who was on the other side of the table sitting on a trading desk. So if you don't intervene at all, you might create dysfunction because you start to have this build-up and you end up having a run. So not intervening at all is a mistake. If you intervene too much, it's also a mistake because what you do is you erase the capacity of that asset to be a hedge. And when you do that, people will look for other assets for hedge. If people are buying, if your currency is depreciating because people are buying dollars, it has to be because people have perceived that a risk that is higher. And you don't want that variable not to reflect the risk. Because if you do, what you do is you create a link to other instruments. In the case of Brazil, if you intervene too heavy, people will go to the long end of rates, and then you're going to have the steepness of the curve going higher. And on that, it's much more difficult to intervene because the government has a debt and needs to roll over. So on that point, I think it's very important to go back to that issue because it comes up over and over. And I think one of the things that we learned is if you stick to the principle of separation, and you communicate well to the market, and you only intervene when you have a functionality problem, either liquidity gaps or a mispricing, or you have maturity of something that's very big coming. Other than that, I think what you do is you create more distortion than you're actually able to fix. As to the long-dated debt, I think one thing that is very relevant in Brazil is we were able to switch our external debt for local debt. And everybody said, okay, now you don't have any fragility on the dollar anymore. But that's not entirely true because what we did is we switched external debt for long-dated internal debt. Guess who buys the internal debt? The foreign investor. What do they have to do to buy the foreign? They have to sell dollars and buy reais. So if there is a run on the long end of the curve, you also have a demand for dollar. Those things are very linked. In Brazil, actually, that has diminished. You have some other countries in which this relationship is much bigger, much more intense. So I think the strategy is very good because at the end, you are issuing debt that settles on your own currency. But you can't forget that part of the reason that allowed you to do that is because you switch external debt for long-term internal debt. And that has also a dependency on the dollar.
You raised some great points around feedback loops. Governor, do you want to jump in and comment and react to that?
I don't know whether I should jump in that side or this side, but let me just make two quick points. I think a lot of emphasis is put on the interest rate differentials and them driving flows. I will be very careful about it. We established that in our case there is a very strong correlation between the South African 10-year government bond yield and the US 10-year government bond yield. So the key driver of capital flows into the South African bond market is the differential in the bond yields, not the differential in the policy rates. And the two are related, but I think that it's very important that we distinguish that. The second point is on intervention. I'm not entirely convinced about FX intervention, and somebody must say something about its efficacy. But Roberto is a very good diplomat because he says you come in if there is dysfunctionality, which is almost how we almost defined it in South Africa. We will only intervene if there is dysfunctionality, and they said, but how do you identify dysfunctionality? Well, if you go to the market and you can't find a price, that means there is dysfunctionality. That you don't like the price does not mean that there's dysfunctionality. So live with the price that you have. There is a price. You just do not like it, and you don't want to trade at that price. So it's a very delicate distinguishing factor. But Roberto and I were not governors then. Our two ministers then believed that there was a conspiracy in 2010 that some chaps are sitting in the developed world and they are engaged in a currency war to make our currencies too strong, and that it is making our life hellish. And so at that time, we didn't call it intervention. We said the dollars are so cheap, so we are going to buy them, right? So we accumulated reserves during that period. And in that instance, intervention plays a very important role. But then you've got to say why you are doing what you are doing so that you do not actually cause uncertainty in the markets. And so when one talks about this thing, communicating a clear policy intent of why you are taking the action you are taking is what becomes crucial, so that the market actors know what you are doing and why you are doing what you are doing.
Governor, I'm going to stay with you as we pivot towards some of the challenges of the future. And one that I wanted to tackle with you is the increasing digitalization of cross-border flows. We've seen money move swifter than ever before through different channels, thanks to e-commerce, digital services, the way capital markets have been reshaped. As you think about the future, is there a blind spot for policymakers because of this digital change we're seeing in capital flows?
Well, if there was a blind spot, it will stop being a blind spot because we know about it. And the reason it's a blind spot is...
You can know about it but not see it, though.
The reason it's a blind spot is because we are not seeing it. And I'm not sure where it will be coming from. But let me put this, and Roberto knows more about this digital stuff than I do. Say that increasingly, or let me say that in many low-income countries, remittances become a very important source of capital flows. And they are very expensive to transmit. And one of the big things that we have in the G20 and the Financial Stability Board is to bring down the cost of cross-border remittances. And in bringing the cost of these cross-border remittances, necessarily means that you are relying more on technology and you are relying a lot more on digitization. So in Southern Africa, we had come with something called transactions cleared on an immediate basis on a cross-border basis, and that with interoperability, you will be able to move the money very fast. And of course, now you said, I wouldn't call it a blind spot, but rather, what are the risks that we are identifying down the line? And one of the risks that we had identified had to do with terrorist financing and money laundering. So you are making these things speedy and all of that. It was bringing all of that. And so one of the earlier things we did in the FSB process was to bring the AML standard setter, FATF, much earlier, so that we can begin to deal with regulatory expectations in these things and say that what we are focused on here is to have money being transmitted across the borders cheaply and efficiently and very fast, and that becomes an important issue for us. There might be things we do not see. That might be other risks down the line. If we know about them, I suppose we can deal with them.
First Deputy Managing Director, do you want to jump in and just respond to some of those comments? The Governor just put the ball on the tee for you.
Actually, I think you should bring Roberto in because he's the person best. But I'm happy to follow Roberto, but why don't you go first?
Okay, thank you, Gita. So in terms of cross-border transfer, I think that's probably an issue that collectively, when we look at globally, we haven't advanced as much as we could. I remember, I'm never going to be as entertaining as Lesetia, but I'll tell you something. In 2019, I had this presentation and decided to put a question. The question was, what's the fastest way to transfer £1 million from São Paulo to London? And one of the options was a multiple question, and one of the options was by plane. And everybody thought that was a joke, but that was the fastest option that we had at the time, which is around 9.5 hours. So like I said, I'm never going to be as entertaining as Satya, but I think we have evolved a lot from that. We still have a lot to do. But I would break up this challenge in 3 parts, okay? And 3 phases. The first phase is, do we have the technology to do like a wide transfer system? And for a long time, we thought we didn't have it. Especially, we could have some systems that will connect integrated systems to integrated systems. But then if a country created a system that was DLT, then to integrate the DLT with the integrated system was very slow. So it was a problem. But that was surpassed. Then we say, okay, now we have the technology and we could integrate a lot of things, but it's not only about the technology transaction. You need to do the settlement. You need to have transfer of resources. So that was a big challenge, and I think today we have the technology to do that too. You have Nexus that is working in Asia. You have some other systems. If you are connecting DLT to DLT, you can have what we call liquidity token pools. So that has been solved. So, interestingly enough, the technology is here, and we can do it. But then you go to the third problem, which is the governance, which I think is what Satya mentioned. And on the governance, you have 3 dimensions of problems. One is the AML and everything that connects to it, which if you want to do a system that instant and does millions and millions of transactions a day, it's very hard to have a setting in which you can predetermine which kind of conditions are there. So you need to have common conditions. So the first one is the AML. The second one is taxes. In many countries, you are taxed depending on whether you're foreign or you're local, or you're a citizen or you're a company. And so if you don't have a common thing, you wouldn't be able to integrate these platforms. And the third one, which has arrived more recently in our talks, is the liquidity gates. So imagine that we had a system that connects everybody. How would you feel about a Brazilian, for example, waking up in one day and deciding that he wants to transfer all his money from Brazil to a bank in London and buy a CD of an English bank? So how vulnerable are you if you have this huge ability to transfer liquidities? And I think those are the 3 things that we need to talk about, because the technology is here. We can link a lot of payment systems, and I think that will reduce a lot the friction of international payments and international trade. And this is something that we want to do on the G20.
I'm glad you still see London banks as safe, number 1.
Happy to jump in now. So, agree with a lot of what has been said. Of course, we have to make the distinction between crypto and digital money, including CBDCs and stable coins and so on. If you think of crypto, exactly with what they said, you could have much faster cross-border flows, but it does come with risks of evasion of capital controls, AML, anti-money laundering, counterfeit and terrorism financing. All of that comes in. And that takes me in the direction of looking at the world we are in, where you have very serious geopolitical risks. And because of the growing number of sanctions that have been imposed on countries, you are seeing crypto being used for cross-border, moving money around to evade these kinds of sanctions. And it's happening not just in the space of crypto, but if you look at where the money is going, because of the geopolitical tensions, we do see a shift for example, in terms of where foreign direct investment is going. So if I start with, you take, say, the US plus block as one side, and you take the China plus block at the other end, and you look at the FDI flows going across those have gone down by around 20% relative to flows within geopolitically aligned blocks. So again, in terms of the question of capital flows and where the money is going, we are seeing the use of crypto to avoid sanctions, but we're also more generally seeing that good kinds of capital flows are reacting to fragmentation risks. And this obviously has implications for all countries. FDI is a great way of transferring technology, of building up growth in countries, and that is the risk for low-income countries and low-middle-income countries.
Professor Mann, The fragmentation risk, let me turn to you on that, because decoupling, de-risking, fragmentation, deglobalization, these are all themes we're talking about a lot in our heightened geopolitical environment. What threat does that pose to capital markets?
So there are two threats when it comes to global fragmentation, and I think it is important to distinguish between two blocks where, if they're really big, you can get pretty much a lot of the benefits of capital market integration, trade integration, meaning bigger markets, lower prices, diversification of portfolios, and that sort of things. You could. However, if you look at the data, it is not global fragmentation on either trade or finance that we're looking at. We're looking at global disengagement. It's actually less trade, less financial integration, less trade integration. And once you start to realize that fragmentation isn't quite the right word, but disengagement is, then you have to tell the story about what are you losing. Now, we can argue maybe there's security gains and so forth and so on, but quantifying what you're losing, and the IMF has done quite a bit of work on quantification, along with other authors, on quantifying what you lose when, in fact, there is disengagement on both capital side as well as on the trade side. I think it's important to always come up with this equation that says you want certain outcomes, and you're going to use certain policy tools to try to get there. But what are you giving up? And I think the magnitude of what is being given up in the context of global disengagement is actually quite large. And the equation is not adding up into a way that is beneficial for emerging markets for sure, but it's not ending up in a positive way for advanced economies either. Let's think about the consequences of disengagement in the context of the supply side of an advanced economy. It means slower productivity growth, slower capital accumulation, less financing available for skills and so forth at company level. So that creates a speed limit problem for central banks. I get restricted into what I can do with my policy if the speed limit of an economy is slower. And I don't think that we also get rid of a volatility. Somehow nearshoring, onshoring creates a less volatile environment. In fact, it creates a more volatile environment, and work by my colleague Silvana Tenrejo has shown that. So in terms of what you gain through global disengagement, I think that people are unwilling to look at the price that they are paying for global disengagement.
Professor, as we talk about some of the risks externally, what about the internal risks? Because when we talk about the UK, it's impossible not to talk about the recent lesson around the former Prime Minister Truss with her mini budget and sort of reaction we had on yields. Did you think that constituted a risk to capital flows, that was a sort of warning even that the UK could be vulnerable? I was going to come in earlier on this discussion about how fast capital can move and so forth and so on. I mean, we have a lot of visibility into certain types of capital flows. We have less visibility into a lot of other actors. We have supervision and regulation over a certain set of actors. We know everything about them. We don't know as much about who they engage with, where. And this also comes up in the context of crypto, and will come up in the context of CBDCs as well. So there is, we were talking about blind spots, there are murky spots, the dark corners that we talk about, the dark corners that we don't know as much about. BIS, of course, is working quite a bit on this, but to say that we know enough about this, that would be not true. Professor, as we talk about disengagement or fragmentation, different terms here, I was talking to the World Bank the other week, and they were talking about just what large percentage still of poorer countries have not recovered to pre-pandemic levels, rising debt burdens. How difficult is it going to be to attract money back to these countries, given the type of playing field, the type of environment we're talking about?
Yes, I fully agree with Dr. Mann that this is really a bad moment. I mean, it is disengagement, actually, and it is going to hurt definitely advanced economies, but obviously more emerging markets and the worse frontier economics, because they even didn't recover and they didn't show the resilience, obviously, that emerging markets shown. So here, I think, I mean, it's very difficult. If it is all going to be driven by geopolitical, issues, there's not much those countries can do. So if you ask me, what they can do, they have to focus on what is in their control. And what is in their control, and this is both for frontier economics and emerging markets, is their own policy frameworks, their own policy credibility, because there's obviously, cannot do much in terms of, what is going on from the advanced country side, from the US, in terms of all this engagement, because at the end of the day, this debt burden is going to come back and haunt you, right? And by the way, nobody's safe from that. I mean, I think we still don't have a good understanding why US defies the gravity, but we know from UK, we know from Japan. I mean, no country really safe from this issue, because at the end of the day, it is extremely difficult to separate that fiscal policy, monetary policy, and how fiscal indiscipline is going to come back and haunt you, right? I mean, fiscal indiscipline is always going to come back and haunt you. Emerging markets learned this lesson the hard way in 80s and 90s. That's why they are very, very careful about it. I think frontier markets have a lot more to do in that sense. I mean, especially because there isn't a clear debt resolution framework for them. There is this China issue lurking in the background, going back to muddy and dark corners. If that's the main lender there, obviously that has its own risk. But at the end of the day, if we really want to use good times, for the best, because there will be bad times. There will be more pandemics. If this disengagement goes further, there will be times that the government needs to spend money, needs to be in debt. So you improve your monetary policy credibility, your policy framework, so that you can use those to bring markets. I mean, this goes back to exactly this, actual effects intervention issue, right? I mean, why you are vulnerable still to the market discipline, market punishment, even you only borrow in your own currency, because there's always this other dollar end, right? And that goes back to sentiments and expectations. I mean, think about advanced countries. What advanced countries worried a lot during this episode, right? Inflation expectations, right? I mean, that they were really worried about that. I mean, this is the same thing with, emerging markets, in terms of, if it is about, look, there are these things I cannot control in terms of geopolitical, but there are things I can control that bring the, international capital market finance to my country, right? Given that I have limited fiscal space and I have these debts that I also need to deal with, then that's really about, affecting the sentiment, expectation of those investors. That you do, the only thing in your control to do that is your own policy credibility. The only thing you do is like, look, if I'm a central bank that I'm telling you I'm going to target inflation, my goal is price stability, that's what you do. That's what you do. You don't go and try to manipulate the capital flows and exchange using pulse rate. You can use other tools for that, but you really do what you say. That is going to be your only tool to affect the market sentiment, market expectations about your exchange rate, which come back to success of your FX intervention. And I really want to give here, the example of Turkey. And this goes back before pandemic, before Fed hikes, before 2020. So it's a very good example. You can burn billions in weeks, right? It's going to do nothing. It's going to do nothing for your currency if you really don't have that type of monetary policy credibility. So I think, and if you have a lot of debt, you are going to lose that, because you are going to mess up the market expectation, you are going to mess up the market system, market sentiment. Market is going to punish you sooner or later. So in that sense, I think it comes back to really your monetary policy credibility, how you really kind of coordinate fiscal policy as much as you can, and make sure market doesn't come back and punish you.
We've got about 2 minutes left, so let me turn to you first, Deputy Managing Director, just to comment on some of the challenges here and respond to what you've heard from the panellists.
No, I think this has been a great conversation. The one thing that's come through uniformly is the importance of having simple, sensible macro policy frameworks and building up your credibility. Just looking ahead, we are in a world where there is disengagement, but Kathy, there is also very clear signs of fragmentation. And emerging and developing countries have to navigate that world. Second, it's a world where there are lots of big spending needs, including for the transitions and the climate transition, climate finance. So, estimates of what it would take for emerging markets for their climate finance transition is that they would need about $1 trillion from international markets. The total amount of gross flows going into emerging markets as a whole right now is $1 trillion. So just the magnitude, that would mean you're expecting a doubling of flows. So what does all that mean? All it means is that I think for a lot of countries, a lot of emerging markets, developing countries, low-income countries, looking inwards is also going to be a very important part of the solution. Everything that can be done on policies, including that enhanced growth, are going to be absolutely critical. Domestic resource mobilization is going to be absolutely critical. That includes, on the fiscal side, making sure you have efficient spending, making sure you're raising enough revenues, but also that you're developing your local financial markets, because that's one way that you can build resilience and also get the financing that you need. And by the way, this domestic resource mobilization initiative is something that we at the IMF are working on with several countries. And I'll leave it at that.
You've taken us right to time. I think you've done this before. First Deputy Managing Director, thank you very much. Governors and professors, thank you very much for joining us. We appreciate your time today.
Thank you.
Thank you very much.